Tonight, the phrase collapse watch is not a meme, and it's not a guarantee of a crash tomorrow morning. It's a state of the market. It's what happens when the foundation under prices starts to weaken, when the numbers begin lining up in a way that tells professionals the system is becoming fragile. And right now, that fragility is showing up in multiple places at once. Volatility that refuses to fully calm down, liquidity that feels thinner than the headlines suggest, crowded positioning that can unwind violently, and a market that keeps reacting to uncertainty like it's running out of patience. At the same time, silver is doing something that always gets attention in serious money circles. It's accelerating upward in a way that suggests the market is starting to price a deeper kind of risk. Not just inflation might be sticky, not just growth might slow, but the bigger question, what happens when confidence in paper assets starts to wobble at the same time physical constraints tighten? That's how you get a silver surge toward a number like 75, a level that doesn't just represent upside, but a potential regime shift. Here's the first thing you need to understand. U.S. markets don't collapse because of one bad headline. They collapse when the system becomes tight, crowded, and overconfident at the exact wrong moment. A collapse is rarely the start of fear. It's the end of denial. It comes after months of small warnings most people ignore. The market's internal structure weakens even while indexes look fine. Good news stops pushing prices higher. Rallies feel tired? The same few trades start carrying too much weight. Risk becomes concentrated instead of spread out. And then when something unexpected happens, an ugly economic print, a sudden credit event, a geopolitical shock, a policy surprise, there's no cushion. Everybody tries to exit at once and the exits aren't wide enough. That's what collapse watch means. It's not panic, it's vulnerability. Now, why does silver matter here? Because silver is one of the few assets that reacts to both sides of the storm at the same time. It's a monetary metal and an industrial metal. That combination is rare and it's powerful. Gold mainly reflects monetary fear and currency confidence. Silver reflects that too, but it also reflects the real world. Manufacturing demand, energy transition demand, electronics demand, supply chain demand. So when silver surges during a period of market stress, it's often telling you something uncomfortable. The world is experiencing financial uncertainty while the physical economy is facing constraint. And that's a dangerous mix. Let's talk about the US side first. The market setup that puts America on collapse watch. The biggest issue is not that Americans stopped spending overnight. It's that the consumer is increasingly stretched. When households rely on credit cards to maintain a lifestyle, that's not resilience. That's borrowed stability. When housing remains expensive and refinancing is no longer easy, that pressure doesn't stay in housing. It spreads into everything else. When insurance, healthcare, and food costs stay high, families don't feel a soft landing even if GDP looks okay. And when people feel squeezed, spending becomes fragile. They don't stop spending all at once. They cut slowly, then suddenly. And when enough households do that, corporate earnings begin missing expectations. Then layoffs start creeping in. Then confidence falls faster. This is how recessions move from theory to reality. At the same time, financial conditions remain tight in a way most people underestimate. Higher interest rates don't just affect mortgages. They affect corporate borrowing. They affect private equity. They affect commercial real estate. They affect banks' balance sheets. They affect the cost of carrying debt across the entire economy. When rates rise and stay elevated long enough, something always breaks. It's just a question of where. Sometimes it's a bank. Sometimes it's a fund. Sometimes it's a leveraged sector that looked stable right up until it wasn't. Now layer in the market structure. Modern markets are heavily shaped by systematic strategies, funds that buy and sell based on volatility, momentum, and risk models. When volatility rises, these models often force selling, not because fundamentals changed, but because their rules demand it. That creates a feedback loop. Volatility rises, selling increases, liquidity thins, volatility rises more. This is how you can get sharp drops even without a dramatic piece of news. The market becomes a machine reacting to stress. So when we say collapse watch, we're talking about a market that is set up to react badly to surprises. Now look at silver's move towards $75. A number like $75 matters because silver is a smaller market than most people realize. It does not take the same amount of money to move silver that it takes to move the S&P 500. And because silver has a physical constraint, because it's used and consumed, the market can tighten faster than the financial world expects. When investment demand rises at the same time industrial demand remains strong, the available pool gets smaller quickly. That's when price moves become sharper and faster. And here's the key. The silver market is not just a chart, it's a supply chain. It's a pipeline from mines to refiners to manufacturers to vaults. If any part of that pipeline tightens, mining output, refining capacity, shipping delays, industrial contracting, the market feels it. But the public often doesn't see those constraints until after prices move. By the time everyone agrees there's a shortage, the repricing has already begun. So what would it mean if silver actually pushes towards $75 while US markets remain fragile? It would mean the market is pricing multiple risks at once. First, it would suggest that the demand for hedging is rising. Investors don't move aggressively into silver if they feel safe. They do it when they want protection. Second, it would suggest the dollar's strength is not enough to keep inflation risk fully contained. A weakening or unstable currency environment tends to lift metals. Third, it would suggest industrial demand is not slowing fast enough to relieve pressure. In a recession, industrial demand can fall, but the energy transition and tech infrastructure build-out can keep demand elevated even during economic cooling. That keeps the floor under silver in a way many people underestimate. Now let's talk about the chain reaction that could follow. If stocks start falling hard, the first phase is usually sell everything. Forced selling, margin calls, risk reductions. In that phase, even silver can dip temporarily. But then the second phase begins. Capital rotates into what feels like protection. Historically, that's cash and treasuries. But in a world where inflation still matters and debt is huge, hard assets start competing for that protection flow. Silver benefits because it's cheaper than gold, more volatile, and can deliver bigger percentage moves when momentum shifts. That's how you get a silver surge during market stress. It doesn't always happen on day one, but once the market starts believing policy will eventually respond, rate cuts, liquidity support, emergency measures, metals often move sharply because the market anticipates easier money. Silver tends to react aggressively to that anticipation. Now, what happens to everyday Americans if this scenario plays out? First, expect financial conditions to tighten even more for households. Banks become cautious during stress. Credit becomes harder to get. Borrowing costs don't fall immediately even if rates change. Lenders tighten standards. That can hit car loans, small business loans, and mortgages. Second, expect volatility in retirement accounts and portfolios. Even people who don't trade feel it when markets drop because retirement savings are deeply linked to equity performance. Third, expect a narrative shift. When silver and gold are rising sharply while stocks struggle, it changes how people talk about the economy. Confidence becomes fragile. Consumer behavior changes. Spending slows further. That can deepen the downturn. But here's the part most people miss. A collapse watch moment doesn't always end in collapse. Sometimes it ends in a controlled reset. Prices fall, leverage unwinds, policy responds, markets stabilize. The danger is that the line between a reset and a collapse is thin when liquidity is tight and positioning is crowded. That's why the silver move matters. It's not proof of collapse. It's a signal that stress is rising and the market is starting to price protection more aggressively than before. So, if you're watching this unfold, the real takeaway isn't to panic. The real takeaway is to understand what the market is communicating. Silver surging towards $75 is the market's way of saying something is tightening, either in confidence, in currency stability, in supply chains, or in all three at once. And U.S. markets being on collapse watch is the market's way of saying the system is vulnerable to shocks and it won't take much to trigger a violent move. And if you stay to the very end, Here is the one line that ties everything together. The line that makes this moment so important. Markets don't break when fear is high. Markets break when fear is rising and people still think they're safe. Silver moving fast while stocks wobble is not a coincidence. It's a warning. It's the sound of pressure building beneath the floor, right before the market decides whether it holds or gives way.